What we're really talking about today is being competitive, but what that really means is trying to generate some economic growth. We've got GDP figures for the fourth quarter of 2012 that come out at 9:30 tomorrow morning, and I think they're about 80% likely to show negative growth for the fourth quarter, and about probably 60% likely to show negative growth for UK GDP for the whole year. And that is not an acceptable situation. It is true that unemployment is falling, but it's sort of falling in a Parkinson's law sort of way. People work expanding to fill the time available rather than in a productive sort of way helping make people more prosperous. And you can see that in the average earnings figures, where the latest private sector average earnings figure shows an increase of only 1.3% as against inflation of just under 3%. So living standards are still declining on that basis. So what I want to talk about today is what we can do to change that situation, because I don't think that's acceptable. And we'll go through the policies that are necessary for us not to end up in a dangerous cycle that's engulfed some of the weaker European economies and got them into what I call the competitiveness trap. It builds on the three previous lectures and starts to look at the policy prescriptions that would make Western economies more successful. And what I should say is that I will use the UK as the example throughout the lecture, but I think most of the points I make are fairly relevant to other Western economies in Europe and also to the United States, although to a lesser extent there. Now, let me repeat some of the points that I made in my earlier lectures, because some of you will not have attended them, and also with a 2-month midwinter break, some of us may just need to be reminded. I even need to remind myself what I said 2 months ago, and I'm sure some of you will need to try and remember what I said 2 months ago. My first lecture tried to describe what's currently taking place, the industrialization of the emerging economies and the shift from the west to the east. I tried to describe that as the world's greatest ever economic event. We attempted to prove this by comparisons with various other events in economic history, and the conclusion was that compared with the most important previous event, which was the Industrial Revolution, what we're seeing today, the industrialization of 2/3 of the world, is 9 times more widespread and is happening 3 times as fast, which explains why some of the policy challenges that it's presenting for us are unprecedented. I've described what's happening in the emerging economies as super competitiveness, and it also generates an unusual pressure on the trading performance of the traditional economies. The second lecture looked at the supply of primary products. The argument presented was that for industrialization to become pervasive, rather than just the monopoly of only a few nations, places severe pressure on the availability of primary resources. And I had some technical experts who came and helped on this, and we looked at the outlook for energy, minerals, food, and water. And the conclusion was that there would be sufficient supplies of all of these, but that except possibly for energy, there would have to be higher real prices to justify the investment that would have to be necessary to meet the demand. And in particular, it looked likely that there would have to be much higher prices for minerals. The third lecture was more academic, though I think in retrospect I suspect I fell a bit between two stools and making it too technical for the generalists and too general for the technicians, the academics. I presented a new theory of economic growth, which showed that the 2 major constraints on growth in Western economies were trade competitiveness and inflation. Now, I believe that using this new theory as a forecasting tool, which has enabled my colleagues at CEBR to be top of the league table for forecasting UK GDP. Incidentally, if the number that comes out tomorrow morning at 9:30 is a certain number, we will be top yet again, although it depends. The jury is out on this, so we will have to see. But being top 2 years in a row is most unusual. Normally what goes up goes down in these things, I'm afraid. But anyway, I mean, we think we've been both sort of moderately competent but also lucky. The bodies that have not been relying on our theory but on traditional theories like the Bank of England and the Office for Budget Responsibility, or Office for Bad Predictions, as we prefer to call it, they, I think, have been beyond the laws, the rules of statistical probability in their forecasting errors. In the case of the Bank of England, actually, I did argue that it probably didn't matter because Sir Mervyn King, he's been criticised quite a lot, but I think that one of the good things he's done is he's ignored his own staff forecasts. And he has actually expanded the economy rather faster than his staff would have encouraged him to. He's suffered from them leaking to the FT as a result of the not being very happy about the fact that he hasn't accepted their points of view. But I think he's been right and they've been wrong, as has the FT been wrong, as it normally is. So I don't think the problems with the bank have been particularly serious, but I do think the problems with the OBR have been unfortunate, because when you've got a coalition government, the technical experts tend to be sort of treated as arbiters, as it were, and tend to have an unusual degree of influence. And I think their bad forecasting has been one of the reasons that the coalition has been relatively slow in focusing on the need to get economic growth into the UK economy. They've lost 2 years, I think, as a result of these bad forecasts. Now, the point about the new growth theory is that in the modern world, with international trade pervasive, balance of payments performance is critical in determining rates of growth. And for small countries where inevitably they won't make much of what's consumed because the vast range of things that people might want to consume are likely to be made elsewhere, balance of payments performance is in effect largely export performance in this context. Now, in theory, you can solve all these problems very simply by just devaluing. As long as you don't lose the cost benefits from your devaluation by generating more inflation domestically. And it's making sure that you don't lose the benefits from devaluation through inflation that becomes critical. If you've got low inflation, not only are your costs rising more slowly than elsewhere, which gives you a competitive advantage itself, but also, and this is where it gets a bit techie, but just accept it, the fact that you've got lower domestically generated inflation gives you scope to devalue a bit more and steal a bit of a competitive march without breaching your inflation targets. Now, given the focus that I put on international trade performance and inflation, it's not surprising that the critical economic policies, as I'm going to highlight today, are mainly export-related or inflation-related. They're exchange rate policy, competitiveness policy, and inflation policy. Let me deal with each of them in turn. First, exchange rate policy. Given its role in affecting trade competitiveness and its impact on inflation, I will deal with exchange rate policy first. The economics are pretty simple. If you devalue by 10% and there is no knock-on effect on domestic costs, you're able to sell your products roughly 10% cheaper in export markets, though less if there's an import content. Alternatively, you can decide not to give all the cost reduction in currency terms to your customers and instead share it with your profit margins. Given that a typical profit margin might be about 10% on an export product, a 50-50 split of your 10% devaluation, in effect, boosts your profitability by a half, which creates a real incentive towards exporting and will incentivize things like marketing spend and probably product innovation as well. The academic research on this is pretty supportive, that there is a sensitivity of trade performance to exchange rates. And indeed, if you look at the economic policy throughout the world, you can see that most people who run economic policy believe that. That's why Germany and Japan, when they were recovering after the Second World War, tried to keep their currencies as low as possible. And indeed, I think it's a plausible explanation of the German attachment to the euro that it preserves an undervalued currency for them. While, as we know, in China, there has been a fairly serious attempt to ensure that the renminbi does not shoot up, and very aggressive official policy has been made to try and keep the currency competitive. The downside from devaluation is inflation. There is a theoretical construct which we use in economics called the law of one price. And that says that prices adjust until the full impact from devaluation has been eroded. But actually, this is a theoretical construct. It doesn't normally work in the short term in most circumstances, although it may in the longer term, in real life. Although there have been occasions when devaluation has actually had a more than full effect, when it's triggered a wage price inflationary spiral, which could even make the net effect negative. I mean, we had this with Britain in the late 60s and early 70s to some extent. So any government needs to be extremely careful about a policy of deliberate devaluation. The minimum inflationary effect of devaluation is the upward impact on import prices. Now, things, primary commodities like oil are priced in world markets, world prices, so 10% devaluation automatically raises their prices in sterling terms by 10%. Other importers have some scope between taking part of the hit in their profit margins and passing it on in full. And the type of impact normally depends on the market conditions. For example, if you look at cars, it's quite interesting. Those who sell cheap cars, normally when the pound falls and they're importing cheap cars into the UK, they normally take the squeeze on profit margins and don't raise their prices. Whereas those selling luxury cars, Ferraris and things like that, you normally find that the price goes up by the full percent of any devaluation. In addition to the direct impact on import prices, there's also an impact on those parts of domestic prices which are internationally based. Energy is an obvious example where the price of the base products is essentially set by international price levels. So what I'm saying is devaluation is by no means a cost-free option. Also, constructing a policy to keep sterling low is also difficult. A little devaluation is something like a little pregnancy. It has a tendency to get bigger. This is because the currency markets think, if they think that you're trying to weaken your currency, the traders tend to shun the currency, and pretty soon you have a full-scale currency crisis on your hands. So, although I think that we are moving into a world, particularly this year, of currency wars, I think the optimum strategy is to be opportunistic and not to look too much as if you're trying to force the currency down, because I think if you do so, it can easily move towards having an undesirable extent. Many commentators have forecast that sterling will weaken this year. For example, Stephanie Flanders in her BBC blog about 10 days ago. I suspect they're right, although the precise timing of exchange rate movements is always difficult to predict, particularly by economists. We have an extraordinarily bad track record of trying to do this. So I would not pay an economist to forecast exchange rates because it's a waste of money, frankly. And I say this as an economic consultant, someone who makes a living out of this kind of thing. I try not to get people to ask me to do this because we're not very good at it. But I think in the long term, it is realistic to expect sterling to be a weaker rather than a stronger currency. Although, of course, when you start making an assertion like that, you tend to think, well, what is it going to be weak against? And I can see why it might be weak against the renminbi. I suspect it might be weak against the dollar. But will it be weak against the euro? I think it depends whether the euro breaks up or not. If the euro does break up, which is certainly more likely than not, I would imagine that sterling would weaken against the German part of the euro and would almost certainly get closer to the southern European part of the euro. My next range of policy options is those that, without devaluation, improve international competitiveness. Now, one of the developments in my 40 years of working as an economist and looking at the UK economy is that the impact of competitiveness has increasingly tended to focus rather less on the sales abroad of domestic firms and rather more on the inward investment, the shifting of inward investment of new people coming into the country or leaving, as the case may be. Now, if competitiveness works through international investment rather more than through just expanding and reducing, depending which way it's going, the trade in, from existing factories, what that means is that the lead time between any change in competitiveness and the effect on international trade, the lead time is going to get longer because it takes a lot longer to move from a devaluation, say, or an improvement in competitiveness of some other kind that then encourages investment, that then encourages exports, than it would be if the link was simply between the change in competitiveness going straight onto exports. And I think one of the things we have observed in recent years is a lengthening of the lags in this. Now, some people have interpreted that to say that competitiveness policy and currency policy don't have much of an impact. I don't think that's true. I merely think it's more difficult to observe from the statistics because of the time lags that have got built in. Now, perhaps the best economy in the EU at trying to make itself competitive, and particularly doing it in a fixed exchange rate context, is Ireland. The Irish, there's a lot we can learn from the Irish. The corporate tax rate is one of the first things I'm going to talk about. One of the current government's less heralded policies, which will have a long-term beneficial effect, is that of bringing down the corporate tax rate. The UK rate is scheduled to be 21% next year, which will be the lowest rate in a major economy, although still noticeably higher than the Irish rate of 12.5%. Now, quite a lot of academics claim that corporate tax rates don't affect investment. I think the statistics don't really back them up. I don't think actual behaviour backs them up. But let me just give you an anecdote from my own experience, which is when I explained the impact of Nigel Lawson's 1984 corporation tax reforms to the corporate head office of IBM, where I was there the chief economist in the mid-1980s. And when they heard what Nigel Lawson done in 1984, they said, wow, we really need to revisit our investment strategy towards the UK. Sorry, I'm trying to mimic the accent. It really did have an impact on them, the fact that the corporation tax rate had been cut from 50% to 33%, I think it was, in 1984. And I think it's very telling that the Irish, under massive pressure, because the Germans tried very hard to get them to raise their corporate tax rate as part of the terms for the Irish bailout, they absolutely dug their heels in. And they did so under huge pressure. And the fact that they did so suggests that they feel very strongly that their low corporate tax rate is very good for the Irish economy, which I think it probably is. It is important to note that corporation tax is a relatively small part of total tax receipts. The chart here, which shows the position, the green line shows the corporation tax receipts as a share of GDP for the UK, the US, France, and Germany. And it shows around about 3% roughly, compared with total tax receipts of 40% of GDP or more. In the UK, just under 10% of total tax receipts. In the other countries, more like between 5 and 7%. Any reasonable variation in corporate tax receipt, in corporation tax receipts, you're probably not going to get more than 0.5% whatever you do. And you could easily lose that. You could easily be negative offsetting effects. So expecting to solve the budget deficit problem, which still remains 8% of GDP in the UK and a bit higher in Southern Europe, through corporate tax, it can make a pretty minor contribution, if that. And arguably lower rates are more likely to get you more tax receipts than elsewhere. The second point to make about corporation tax, I'm sorry, this is for those at the back, this requires a certain amount of reading. is that corporation tax is a very small part of the tax payments that businesses make. In 2010-11, corporation tax receipts were 42 billion out of 162 billion pounds worth of tax paid by the business sector. This list takes you through all of them, and if you want the details to read through it fully, I'll very happily send them to you. So there are lots of taxes there, and these are just the taxes paid directly by corporates. Of course, on top of that, there are taxes which companies pay either through their employees or their customers. Now, it's a bit more invidious saying whether these are corporate or whether they're not corporate taxes, but there is clearly a corporate influence on them. Taxes like VAT, employers, PAYE, etc. And they are yet further contributions. The point I'm making is that trying to squeeze corporates is not necessarily the best way of maximizing tax revenue. It's for this reason that the 2020 Tax Commission, which was set up by Taxpayers Alliance and the Institute of Directors, I was a member of this commission, we went through in quite a lot of detail, and what we proposed is that you didn't tax corporates, but what you did is you taxed payouts. So you taxed companies when they paid salaries, you taxed companies when they paid dividends, but you didn't tax companies just because they earned money. And we showed that that preferred tax approach, even though it would mean lower taxes, lower tax rates, would actually boost both GDP and the tax receipts. We actually estimated that the net effect after nearly 20 years would be about 10% higher GDP. It would take time, but that's what we estimated the effect would be. So that's why I think that the pressure on companies to pay more corporation tax by such campaigning bodies as UK Uncut is so damaging. It's certainly not the case that higher corporate tax payments would avoid the need to cut overspending by governments. And it seems much more likely that an attempt to get corporates to pay more tax would backfire and end up with lower GDP and lower tax receipts, and hence an even greater need to cut public spending. I think that in this area, careless talk may not cost lives, but it does cost livelihoods. Quite apart from taxation, the climate towards inward investment is a critical part of export competitiveness. Now, let me say something about the City of London, partly because we're in the Museum of London, and partly because I think we've been going through a phase where we haven't necessarily fully appreciated some of the contributions that the city has made. The City of London is one of the UK's biggest international trading assets. It generated balance of payments surplus, which peaked at 80 billion in 2008. I would think now it's a bit below 50 billion. It has come down quite considerably, with the city getting very much smaller. But it is still a major contribution, contributing over 3% of GDP to the balance of payments. We'd be in a really difficult situation internationally if we didn't have it. I was fairly critical of the city in the days when it was making a lot of money. So I think I've got a degree of credibility now if I say that perhaps one ought to be a bit less critical today. I think I've got a bit more credibility than those who ignored the excesses when they occurred, but have now taken advantage of the unpopularity of bankers to attack the sector. Now, the current climate of banker bashing, I'm arguing, is unhelpful to the economy, as is the climate of very heavily enhanced capital requirements for banking. When the problem is insufficient bank lending, it is quite bizarre to make bank lending more difficult and then ask banks to lend more. It's an inconsistency intellectually in doing that. And it's not entirely surprising that government ministers give the impression of looking like King Canute. Indeed, trying to deal with banking problems that took place in 2008 by increasing capital requirements today, it's an extreme case of bolting the stable door when the horse is long headed for the hills. Now, I can see why politicians wish to show that they are doing something, which is one of the curses of our modern age, but what they are doing is damaging. What was mainly wrong with the city was two things. One, the markets were insufficiently competitive, which resulted in profits that were excessive, which resulted through profit, the sort of informal form of profit sharing, which is called bonuses, it resulted in excessive remuneration. That was the first problem. The second problem was bad corporate governance, where risks that were being taken on corporate assets were being remunerated to individuals. And a strong board should have prevented that. And the way to deal with that issue is through ensuring proper corporate governance. It's not through having excessively tight restrictions on the institution as a whole. Regulation and increased capital requirements normally actually act to reduce competition and are hence more likely in the longer term to lead to excessive profits. We've mismanaged our economy sufficiently badly over the past 100 years that we have relatively few national economic assets. We therefore need to cherish those that we do have, like the City of London, curb their excesses, of course, but to understand the scale of the contribution that they make to the balance of payments and hence to economic growth. Now, the other areas where the scope to policy to improve trade competitiveness are regulatory policy, labour market policy, personal tax policy, and innovation policy. These are all areas where government policy can create either a business climate that is receptive to investment or can encourage existing firms to export more. There is, at a different level, trade policy as well, but trade policy in the sense of government supporting exporters is normally something where governments struggle to make much difference. Perhaps in encouraging diplomats to be more trade-orientated, they can do a bit, and by being careful about not going too far and implementing certain international agreements, which can sometimes put UK firms at a disadvantage if the UK government gold plates agreements. We can be a bit more, we can avoid placing the UK at a competitive disadvantage, but I wouldn't want to go too far down that route. And there are circumstances where sometimes, because of the buying power of governments elsewhere or their requirement for linking trade with politics, it is necessary for the government to get involved in supporting exports. But in general, it's a mistake to exaggerate the importance of this. Most trade happens without government involvement. In general, I deplore the use of import restrictions to improve trade performance. Although companies can use the shelter provided by such restrictions to improve their performance, they are more likely to use it to support inefficiency and to pay excessive wages and dividends. Where there is a case for using import policy is using the threat to ensure that export markets are opened up. If and quite possibly when the UK leaves the EU, which is a more open question today than perhaps it was 3 days ago, there will have to be some pretty tough negotiating to get reasonable trading arrangements, and it would be foolish to deny the negotiators the negotiating tool. So that summarises things on the competitiveness side. Let me now turn to inflation. Now, it's here that I think we've got some quite novel thoughts which could generate a huge difference by enabling a much more competitive UK economy, and also, by the way, by boosting the standard of living by cutting prices relative to wages. The Institute for Economic Affairs last month published a fascinating study about the use of price reduction strategies as opposed to increasing benefit strategies as a way of improving the living standards of the poor directly. The study by a man called Christian Niemitz, with a forward by Gisela Stewart, who's a very intelligent Labour MP, I thought it was an absolutely excellent study. Funnily enough, I'd been warned about it in advance as I was writing this lecture, and I said, well, hang on, I'm writing the same stuff. But there we are. Maybe great brains think alike or something, or maybe the opposite. Fools seldom differ. Anyway, I thought that their idea was a good one. Because by cutting the cost of living, you can reduce the cost of poverty to the rest of the economy and also improve the working of labour markets by removing some of the disincentive effects of benefits. But I think that the IEA study it focused mainly on the cost of living at the bottom end of the scale. I actually think it applies throughout the entire scale in the UK. There are macroeconomic benefits from getting the cost of living down for households as a whole. There is indeed the prospect of getting a sort of disinflationary wage cost spiral. But, of course, looking at the point of view of competitiveness, the lower the rate of domestically generated inflation, the lower the real exchange rate that can be tolerated without prejudicing an inflation target. So a lower cost of living has a high-powered effect. Now, this data comes from the IMF, and it's subject to the sort of problems that all economic data is, but it's a good first attempt to try and get a sort of sense of what's the comparative cost of living in different parts of the world. And what it shows is that the cost of living in the UK, it's based on the US as 100, and the cost of living in the UK is 9.4% above. But compared with China, the gap is much bigger. Compared with India, the gap is even bigger still. The gap is, I have the numbers here, where our prices are 1.5 times as high as in China, 2.7 times as high as in India. Even compared with Singapore, which has one of the highest GDP per capita levels of purchasing power parity in the world, our cost of living is 1.4 times as high, according to this IMF data. The other data we have on this is from the OECD. Now, this compares, it's a different comparison. It's comparing different things in the UK with the OECD average. They claim that the cost of living in the UK is 11% higher than the OECD average and 18% higher than the US. Remember, this says 18% gap with the US. The previous one says 9%. So bear in mind, there is a margin of error in these numbers. They're not by any means precise. But what is useful about this one is it tells you where the price gap is. And the 11% gap compared with the OECD average, the areas where the gap's biggest are housing and utilities, which is 18%, transport, 31%, recreation and culture, I think that means pubs, 14%, restaurants and hotels, I think that means pubs also, 12%, and miscellaneous goods and services, 15%. Now, the last three of those, the gap is very heavily driven by the cost of commercial property. Let me start with transport, which is the highest relative price element. There's a range of factors. We've historically had high fuel duty in the UK, and other motoring costs have been kept up by a range of taxes and charges designed to disincentivize motoring. Now, I'm giving a Gresham lecture on the 1st of May, which is looking specifically at what we could do to do things a lot better in London. But let me just observe some of the numbers we have here. Public transport in the UK is amongst the most expensive in the world. Both train and bus fares are very high. We have an ex-head of London Transport here, so we've got someone who is in a position to comment in great detail about this. But I do think that part of the problem is the high wages paid to unionised employees. The London tube drivers now earn more than £50,000 a year, bus drivers about £33,000. Now, to put this into context, the base salary of an EasyJet pilot is £43,000, and that of a Ryanair pilot is £53,000. Now, I am the great-nephew of one of the founding executive committee members of ASLEF, so I do have history with the rail trade unions. I think that trade unions do play a very important role, but they should not be exploiting the public in the way that UK public sector transport unions, I believe, currently do. Part of the problem, I believe, is that politicians have put themselves directly in the firing line, and they've been ruthlessly exploited by an unholy alliance of the transport providers and the unions, both to exploit the taxpayers through high subsidies and to exploit the consumers through high prices. Most of the other areas of excess cost in the UK reflect the high cost of property. I pointed out the cost of most service sector activities, where the McKinsey study on UK competitiveness in the late 1990s, which Gordon Bound commissioned, good report that actually, showed that there was a potential of a 20% price reduction through increased availability of property, through planning policies that were more pro-growth. Now, the coalition government has amended planning policies to take account of economic need, and I've actually been, since the amendment took place, an expert witness in a successful planning appeal for a supermarket under the new policies, where it does look as if there has been an impact from the policy change. So we may be moving in the right direction, but whether this is enough will take time to show. But housing is the area where there is a real potential gain from improving planning policy. Now, a lot of people say you can't reduce the cost of housing in Britain because we are much more densely populated than the rest of the world. Well, this slide, which comes from the IEA report to which I referred earlier, which compares regional population density in the Netherlands, Switzerland, Germany, Belgium, and the UK, says that this is not the case. It says that in the southeast of England, the population density is not much more than a third of what it is in South Holland, for example. So there is this idea that we are uniquely densely populated, and so it is inevitable that our property is expensive, simply is not supported by the data that is available. Now, it has been argued in the past that the reason for high prices is because of the excessively easy availability of money. Now, certainly that has been a factor, but its relative importance is not just driven, it's not just that. There's also supply and demand for property. What is interesting is that with mortgages relatively difficult to get hold of over the last 5 years, property prices have remained nearly as high as they were, which does suggest that the issue is a supply-demand issue and a planning issue. It's not an issue driven primarily by monetary policy. The Barker report, carried out by one of my successors as the CBI's chief economic advisor, Kate Barker, showed that in 2004, UK housing costs were excessive and needed to be reduced by increased supply. And of course, since then, the financial crisis and the associated reduction in lending has slowed the pace of housing development even further. And as a result, the shortage of housing has been exacerbated. The OECD, in an international survey of the impact of housing on economic growth, argued that the UK had a particularly low price responsiveness of supply in the housing sector, arguing the long-run price responsiveness of new housing supply tends to be relatively strong in North America and some Nordic countries, while it is weak in some continental European countries and the United Kingdom. And this low elasticity of supply is one of the key factors behind the UK housing shortage. Sir John Banham, who was my Director General when I was the economic advisor at the CBI, recently released a report for the Royal Institute of British Architects, for their Future Homes Commission, which also drew attention to the economic damage resulting from high housing costs and the shortage of housing. And his imaginative proposals included encouraging more pension fund investment into rental housing, and particularly local authority pension fund investment. I think that his ideas surely make good sense. Now, the final area where we in the UK have prices which are much higher than elsewhere is a much more controversial area. It's energy. The Department for Environment and Climate Change estimates that by 2015, green policies will have boosted the domestic price of electricity by 26% and that of gas by 10%. But actually, if you look at the United States, particularly with those states that don't have green obligations, the gap is even bigger. Electricity prices in those states in the US, which have tended just to go for cheap energy, but market priced energy. They haven't taxed energy. They are about half electricity prices of those in the UK today. This data comes to the IEA, and that's worth about $600 a household, so about £400. Now, I think if you want to go for a low price policy in the UK. You have to think quite hard about how you achieve it. What I've recommended is giving the Office for Fair Trading the task of looking over all price levels in the economy. So instead of just simply looking and seeing where people are actually physically colluding, they look instead at whether prices look out of line, both internationally and historically, and make an assessment about where one might expect them to be in UK circumstances, and if they look excessively high, then investigate. I think with that more aggressive approach to investigation, we could start to leverage prices down. There is often the mentality in the UK, which is how much can we screw them for? And I think having a more aggressive OFT would attempt to deal with that. Now, if we achieved OECD average prices for housing, for commercial property, for energy and transport for the UK, we could get the consumer price level down by 8% compared with where it otherwise would be. That is worth just about £2,000 a year per household. So it's not an insignificant amount. Now, of course, these cost savings could not be made overnight. But supposing that they were phased in over 10 years, we've done some economic simulations just to get some rough idea of what the impact might be. And we think that actually you could get GDP up around 15% compared with what otherwise would have happened through achieving that. So such a boost would offset much of the growth weakness which we currently see happening in the UK with growth not much more than 1%. You could get growth, if you took 15% over 10 years, it would bring the average rate of growth up to 2.5%, which is the historic rate of economic growth that we had before 2007. So let me recap. I don't think we're powerless in the face of competition from the emerging economies in the East. They've got weaknesses as well as strengths, and we've got strengths as well as weaknesses. I think we can be competitive, but to achieve this, we have to be focused. We have to accept that in the more competitive world that we find ourselves in, achieving economic growth has to have a higher priority than it's had for most of the past 20 years. Governments over that period have paid more attention to sharing the wealth around than to creating it. They now need to get back to focusing on wealth creation. The good news is that we've got enough fat to cut out to be successful. And if we cut that fat out, the probability is that we will be successful. So we can return to growth, but only if we really want to. Thank you very much. You've been extremely patient. I know one or two of you have looked at your watches. None of you have actually tapped them to see if they've stopped. Thank you very much indeed, ladies and gentlemen.